Hi, everyone. Thank you for joining our webinar. I'm Derek Singston, Policy Director and Counsel for Oregon Business and Industry. My portfolio includes tax and fiscal policy. We're here today to talk about H.R. 1, also known as the One Big Beautiful Bill Act. H.R. 1 makes several changes to tax law that affect businesses and individuals in Oregon. These include changes that extend provisions of the 2017 Tax Cuts and Jobs Act, as well as new changes such as those involving tips and overtime. As you know, Oregon automatically connects to the definition of federal taxable income, and the legislature periodically extends the state's connection to federal tax law for other tax purposes. This connection ensures consistency between federal and state tax codes, simplifying compliance for businesses and individuals. This webinar is particularly timing because there is a possibility that the legislature in the 2026 legislative session will disconnect from at least some provisions of the federal tax code. This would create compliance problems and raise costs for state businesses and perhaps for individual taxpayers as well. To help us make sense of all this, we're fortunate today to have several experts from Perkins Co. Thanks for being with us. Jordan Patterson, Katie Powell, and Trent Bakel. A few housekeeping items before we get started. We've scheduled an hour for this webinar. We might not need all of that time. If we don't, we'll wrap up as soon as you all run out of questions. Speaking of questions, we've set aside time after the presentation to answer them. However, you should feel free to ask questions at any time. To do this, please use the question and answer function at the bottom of your screen, which you can see at the bottom of your Zoom screen. This webinar will also be recorded and posted to OBI's website for anyone who can't be here today. At this point, I'll hand things over to our Perkins panel.
All right, I'll kick things off. My name is Trent Bakel. We're all tax shareholders at Perkins and Company. My main focus is on real estate industry as well as partnership taxation. I also help support our transaction advisory service, and I'll let Katie introduce herself next.
Sure. I'm a tax shareholder at Perkins and Company as well. I just celebrated my 20th anniversary with the company by way of 2 mergers. And my practice areas focus on pass-through entities and their owners. So a wide variety of industries represented there, but particular depth in real estate, construction, and professional services. So I'll be touching on those topics.
And then my name is Jordan Patterson. I'm also a tax shareholder here at Perkins within our tax team. My expertise or focus is with our high net worth individuals, and so oftentimes the business owners. And we're also doing lots of estate trust planning, residency planning, and transactional planning around transitioning the business and just overall financial goals.
Next slide, please, Jordan. Thank you. So, we have 3 of us here because we definitely realize that when talking taxes, it can be easy to hear CPAs drone on. So kind of having 3 different voices, 3 different perspectives. We're hoping to keep this lively. As Derek mentioned, we'll have time for Q&A at the end. We've done versions of this that have definitely gone over an hour, so we're going to be keeping things at a pretty quick pace, and we're going to try to stay out of the weeds as much as possible. We'll let the weeds. We'll dig into the weeds as you have questions towards the end, but here's kind of a quick overview, which is, we're going to talk about what didn't change, because I think honestly that's going to be an area where we're going to be spending a decent amount of time, because we were expecting, or there's a possibility that lots of things were going to change. What did and didn't? What did we have that was enhanced or improved? Some things that went away, and then we'll start to talk about Oregon specifically. Derek kind of teed it up in terms of our automatic connection. We'll talk about that and then have some takeaways and planning themes. And with that, I'll turn it over to Jordan to kind of set the table on what didn't change as part of the OB3 Act.
Yeah. So I think, quick history lesson here is, we had legislation, this Tax Cuts and Jobs Act, and that did a lot of things like lowering our individual tax rates. It introduced items like our qualified business income deduction. It also lowered certain expense thresholds like our state and local taxes, which then incentivized states to create, their pass-through entity tax regimes to kind of counteract that. And so absent this legislation, the OB3, a lot of these things were going to sunset or go away and revert back to pre-TCJA at the end of 2025. And so this legislation of OB3 continues a lot of the elements that we were used to in the last few years and gives us some certainty, and I'll use air quotes, certainty or consistency for a period of time during this current administration. And so, the big thing that I usually talk to clients about is individual tax rates. And so those remain unchanged, starting down at 10%, going all the way up to 37%. And really, historically, if we look at the history of tax rates, those are historically low. And so that still provides us a lot of planning and ease in looking at strategies with our clients. Things like the qualified business income deduction, which we'll talk about more, those remain largely unchanged, but there are some little enhancements here and there with some of these items. But the big overall strategies that we look at conceptually with our clients for planning, whether it's a business or an individual, those strategies and tactics really remain unchanged this year and also going forward into the next couple of years, absent any other legislation or changes. Other things like smoothing out income with installment sales, charitable trust, qualified small business stock, that exclusion if you sell your principal residence, all those things are still available. And those are all different knobs and levers that we look at with our clients year to year. So this is it makes our job a little bit easier, I would say, for right now. There's still some great opportunities and things to consider into 2026. But largely, we get to still play the same sandbox that we've been in.
Yeah, we're a little bit of, kind of Huey Lewis. We're going back in time to 2021. And, probably what would you say, 80% of this bill is really just kind of restoring back to the way that the Tax Cuts and Jobs Act worked back in 2021. As Jordan mentioned, that was a very sweeping bill. A lot for us to learn, a lot for us to get our arms around as that went into effect for tax year 2018. And then there were some modifications to a lot of those provisions starting in tax year 2022 around interest expense limitation, research and development, depreciation. So the last few years, we've been kind of navigating through some of the changes. As part of that, we're really just kind of stepping back in time to 2021 in terms of the tax rules. And, we probably, as Jordan alluded to, we probably should have made that permanent. Deductions remain permanent. There was a lot of things. The word permanent was in OB3 a lot, and it's only permanent until another administration wants to make changes. But we do have that stability for, at least the next 3 years and potentially a little bit further into the future, that we're not dealing with sunsets. We're not dealing with very many provisions that are set to expire on a specific date.
And the timing of this was crucial too. I feel like knowing the law of the day and in the middle of 2025 has been so beneficial when historically we've had huge tax bills passed at the end of the year and even a lot of retroactive provisions. But with this bill passing on July 4th, getting enacted on July 4th, it really gives us a runway for planning. And I feel like that's the key takeaway here. One of the key takeaways is that we've got months here before the end of the year where we can really get some planning formality in place and do the analysis and the modeling that needs to be done to make sure you know which direction you're going as we move forward. But like Trent said, the 2021 and prior legislation was a sweeping tax bill. This too was a sweeping tax bill. There were nearly 900 pages here. And although a lot of it is continuation of things as they already were, there's enough new stuff and enhancements and tweaks to what the rules were as we know them, that there's still some unanswered questions and some uncertainty in some areas where clarity is needed. And one of the things that, even though we're happy to have had this legislation in the middle of the year rather than the end of the year or even early into next year, those areas that do require additional clarity can be impacted by the current state of affairs in Washington. So we're in a government shutdown. The IRS has furloughed nearly half of its employees from an already reduced workforce. They're prioritizing, I think, enactment of this law and the form changes that will be needed as a result of this. But they're building up a backlog of compliance and audit and collections needs while the shutdown continues. So that is something to keep an eye on, is just any areas where you're planning where there's a little bit of uncertainty. It's not going to be right away in the guidance. We were kind of hoping the last presentation I was in, we were hoping that the guidance would be forthcoming in the next few months, but with this current state of affairs, it might be a little longer than that.
I think we can, go ahead and get started on the next slide, Katie.
Sure. Yeah, there's a lot of new stuff or extended stuff that is really, really beneficial to my pass-through businesses and their owners. The depreciation things are huge. Knowing that we've got 100% bonus depreciation as one of the tools we can work with is really a great planning opportunity for my clients. What has happened over the past few years is we've been working our way down from 100% bonus historically to 80% 2 years ago, 60% last year, and this year, 2025, where we started the year at 40% bonus depreciation. And just to back up and say, what is that? That's the immediate expensing of assets that qualify as for bonus depreciation, which is basically anything that's got a tax life of 20 years or less, with some exceptions and additions to that. So that being able to expense 100% of the cost of those kinds of assets up front is huge. That goes into play from January 20th of this year forward. So there is that brief bit at the beginning of 2025 where it's in that 40% bonus area. I'll go ahead and jump to this section 179 changes. That's section 179. I don't like to throw out tax code sections, but I will say that one's hard to avoid because and that a lot of people know what that means anyway. So I'm going to continue using that. But it's another provision where you can immediately expense the cost of certain assets. The differences between bonus depreciation and 179 are, the key differences are that bonus is on a class-by-class basis. You can elect out for 3-year property or elect out for 5-year property, which means if you elect out, it prohibits you from using bonus depreciation on anything you buy that falls into that class of property. Where section 179, you can pick and choose what you want to expense right away. Using these in a smart way and knowing what your options are can really have a big impact, because what Jordan said up front, the deferring taxes is one of the key tools in tax planning. And these depreciation elements are one of the key timing differences we can use with asset-driven businesses to defer taxes by accelerating expenses.
Yeah, and I think one thing I'll add there on the planning side, where we saw this, again, going back to kind of the 2018 through 2021 timeframe, is really for corporate, on the corporate side of things, because of the interplay of depreciation losses and net operating losses. That if we get 100% bonus depreciation or 179 expensing, you think, oh, well, we get the same deduction. Well, that might not necessarily be the case if it's putting you into a tax loss position. And one of the things that didn't change was our ability to use net operating losses is still limited to 80% of taxable income. Well, if you have 179 expense at a C Corp level, that actually cannot create a net operating loss. It creates its own carry forward into the next year. And so it's a great planning opportunity for C Corps that have major CapEx expenditures in a year that may drive them into a tax loss. Is if we take that instead of, if we take the expensing election instead of bonus depreciation, we oftentimes can utilize the benefit of that quicker than necessarily creating a net operating loss into the future that's limited.
And state conformity is key here too.
Yeah.
Oregon complies with both 100% bonus and Section 179 expensing as it stands. Many states don't. So oftentimes, my multi-jurisdictional taxpayers will run into issues where they're operating or they begin operating in a state that either allows Section 179 and not bonus, the other way around, or some totally different configuration of depreciation elements in their tax code. So, or like, for example, instead of the high limitation that we have at the federal level for Section 179, maybe limiting it to $25,000. So a huge difference on a state-by-state basis. So that has to be factored in as well.
One other thing I was going to throw in here on the kind of what got enhanced and got improved, and sometimes it can be overlooked, but I think it's really impactful to business owners. If you think about, business owners and their assets, what's the biggest asset? Well, it's the business. And so one thing that was going to go away absent this legislation or get significantly reduced was this estate exemption. So currently right now, 2025, we're sitting at about 14 million of a lifetime exclusion, and absent legislation that was going to get cut in half, we think, to about 7 million. And so now we actually have a $15 million exclusion, lifetime exclusion, index for inflation that's beginning in 2026. And so, that's another thing that I think is really important for business owners, particularly if they're in a phase of their business of transitioning to the next generation, really utilizing that and even looking at that expanded exemption that they get each year based on inflation. If you're tapping that out already, that inflationary adjustment on 15 million is not immaterial. And so that provides even enough opportunity there to continue to do planning like that year by year.
Yeah, I was really thrilled to see the qualified business income deduction made permanent. That is so important to pass-through entity owners, anyone whose business income ends up taxed on their individual tax return. That deduction, in effect, I mean, it's a 20% deduction if you qualify for the whole deduction and avoid the limitations, which if you're in the highest tax bracket of 37% at the federal level, a 20% deduction on that drops the effective rate from 37% down to something like 29.6% if in that highest tax bracket. So it can really make a difference and make it a lot more equitable with what it would be if you were operating as a C corporation, which has a flat federal rate of 21%. So having this, but double taxation. So there's some stuff in there that if you qualify for the qualified business income deduction, it really makes it so that you don't have to think so hard about reviewing your entity structure as long as this continues. As it has been. And there've been some enhancements there too. That's why it's on this slide. So the thresholds have been raised for where you phase into the limitations, but basically it means that more people qualify for the deduction than they did before. There's even a minimum $400 deduction for certain business owners who materially participate. So there's some enhancements there that have in essence, it's continued, but with a few more people brought into the fold for this 20% deduction.
Yeah, I know I personally was surprised back in 2018 when we were really starting to look at the changes from the TCJA and that new shiny 21% corporate tax rate, and looked at it with the number of clients of, oh, does it make sense to become a C Corp? And with this qualified business income deduction, oftentimes it really didn't. I mean, there were definitely some areas where it still does make sense. I think, kind of the one thing right off the bat where it can make sense to the corporate versus the pass through of getting this qualified business income deduction is qualified small business stock and the exemption around selling your stock that is a qualified small business stock, and you get to exclude, Jordan, I think you have this information maybe a little bit more redolent, but I think it's 10 million or 10 times your
It's
basic.
expanding
actually,
from
it's
10 million to
15.
15 million now. But
Yeah.
that's one of those areas where if you check all the boxes and qualify for it, it's phenomenal. It's golden tax planning because it's that category where you get to exclude not just a timing difference and with deferral, but to exclude income from taxation. So qualified small business stock is certainly very valuable, and that increase from 10 million to 15 million as kind of the exclusion amount that you're working with can really enhance that for a lot of people who do own C corporations and have started down that path. So there's a lot of quirks with that, though. It's one of those areas where if you're a service business, you may not qualify because certain industries like professional services, healthcare, that kind of thing are excluded. But if all the facts line up, it's golden.
Yeah. Yeah. And the nice thing around it is just that Katie made the comment that the qualified business was meant to kind of put it more on par with the C Corp tax rate reduction. And so it's nice to have these options where it's not just, I've got to go into this bucket because otherwise I'd be paying a boatload more in tax. That's generally not the case with current tax laws, that we've got flexibility in terms of structuring and planning. And so it's really kind of thinking, what is the end goal in mind? And where's the tax efficiency within that? And what are the options? And then it's not just we're going down this one path for 95% of our clients and for our businesses.
So to touch on the Oregon conformity with some of these things, I think one of the key things to point out on this slide is the qualified business income deduction. So while Oregon conforms with the federal definition of taxable income and adjusted gross income, as Derek said at the outset, this is one of those areas where they have specifically denied to conform. They've decoupled from the qualified business income deduction, but on Oregon, there's a reduced rate available for certain qualified income that kind of makes up for the fact that they don't go along with the federal deduction. But this is one of those key conformity areas that we're well aware of and keeping an eye on, making sure that rate availability for Oregon pass-through income is still on the table.
Expanded. I won't dive into the weeds that I really want to on qualified opportunity zones. I've spent a lot of time in this area. I think it's a fascinating program. I'm very pleased that it got extended and expanded. My 2 cents on this is that the timing of COVID really put a wrench into the effectiveness of this. We didn't get final regulations on the existing program until December of 2019. And so we had a few projects and a few clients looking at projects and kind of ready to hit go once we got the final regulations. And then COVID happened and it really slowed things down until probably sometime mid 2021. And so the amount of investment in area, total projects in this area, I think was just really stunted. And they took some feedbacks, and there's definitely some negative feedback, especially here locally, regarding some areas that were designated as opportunity zones. They've made some modifications in there. They've, again, permanently extended this to be a 10-year rolling cycle. So we still have the existing program through the end of 2020 2026, but then starting 1/1/27, we're going to have a new 10-year cycle for opportunity zones. A few slight changes. So we're waiting, to Katie's point earlier, we are going to be waiting on some additional guidance here as it relates to it. It's far enough out that we're not expecting to get that. If we get it by the end of 2026, we'll be pleased. It expands into rural, so there's some additional benefits for rural opportunity zones. So I think they took some of the criticism of, some core business areas, some heavily populated, heavily invested in areas already, and they're trying to redirect dollars into areas that really do need it a little bit more potentially. So happy to see that. Moving on the research and experimentation. So this has been restored for domestic research only. So this was one of the things that changed in 2022, is that prior to 2022, our R&D expenses under old law just automatically were able to deduct them. Starting in 2022, we were required to capitalize them. Had a major impact in a lot of industries. And there was legislation on the table for a couple of years, and they just couldn't get it signed. Both sides of the aisle agreed that this was bad tax law. They got this into the current OB3 Act, and they actually had some nice changes to it as it relates to, there are some small businesses that were able to have some flexibility on those years. They could choose to go back and amend. They could get caught up on the 25 return. They could spread it between 25 and 26 if they want. Some nice flexibility there. But it's restored. Kind of the key thing here is that it's restored for domestic research. So for those businesses that are utilizing some aspect or potentially heavily in foreign research, that is still required to be capitalized, and we're still have to operate under the same rules there in terms of our having to capitalize and amortize those costs over 15 years instead of currently deduct them. But it kind of falls in line with what was important for the administration regarding, focusing domestically, as in part of the planning. This next bullet point, stronger incentives for capital investment and expansions. One thing on that line, going back to depreciation, is a short window, but we've got this 100% bonus depreciation for a new classification of property, qualified production properties. So through 2020, through the end of 2030, that effectively, if you're building some manufacturing, industrial type property for the use in your business, so it's not a real estate play from the landlord side, it's got to be for the operating business, but we can get 100% bonus depreciation. So that's kind of this, it was the administration's way to kind of tackle this idea of, we're relying too much on foreign production, we want to bring some jobs home. That's expensive, we got to build the infrastructure to it. Here's their way of helping pay for that, is allowing businesses to get some very significant write-offs if they're willing to make those investments.
And we've had some discussions internally about that, about whether our clients who are in the manufacturing world will benefit from it or not. And one area that we need to point out here is that the law specifically says that if you are a lessor of a building, you don't qualify for that immediate write-off, 100% bonus depreciation, just because your tenant has a manufacturing business in there. It really has to be the person who, or the entity that owns the building, is the one doing the qualifying activity of manufacturing or refining or producing within that facility, which can be a hurdle for some of our clients who've intentionally segregated their real estate into a separate entity. And I don't know, I haven't seen anything that has come out to allow related parties where it's the exact same ownership of the real estate entity as it is for the operating company, to get around that exclusion from the benefit for lessors of buildings.
Yeah. But point remains that it can be very lucrative and a very incentivizing opportunity these next few years for that investment.
Yeah,
Jordan, you
that
want
was
to
on the
move?
details. I
Jordan, you
just
want to
wanted
move to the
to,
next? Oh,
I
go ahead.
wanted to add one more thing on the research and experimentation bullet point here. It's so beneficial to go for my small business clients, and small business for this purpose is someone or a company that has $31 million or less of average gross receipts. So small kind of counts most businesses in Oregon. And the option to go back and do this retroactively to 2022, 23, and 24, if you haven't already expensed on 24, it's really a beneficial thing in many cases, but it also comes with some quirks. Like you may think just intuitively, this is exactly what we should do. We should go back and amend 22, 23, and 24 and get our unamortized R&D costs that we had to amortize when those tax years started. Now there's a lot of availability of expensing, but you may find when you go back and get into it and start running the numbers that you're running into problems with the interplay and some of these other provisions. So it can mean that your like interest limitation is going to be impacted, or loss carryovers or basis limitations. There can be a lot of things that pop out when you actually run the numbers that maybe don't occur to you just on intuition. So it does take some modeling to see if that's the right move for all the small businesses that out there. And also there's a limited time period in which you can go back and amend those prior returns and get that extra expense. Those have to be done by, I believe, July 4th, 2026. So we've just got a few months. And back to where I started with the IRS shutdown, furlough, if you are not able to send those through as e-filed tax returns, if you have to do a paper filed tax return for an amended 2022 return, for example, outside the e-file window, then it's going to take some time to get that tax return processed. Just to expand on that and say, okay, there's a benefit at the federal level, but again, because Oregon conforms with federal taxable income for all of those prior years, and I don't see anything going back in time changing that. If you get that deduction up front for your federal tax return, you'll also be amending Oregon and any of the local returns you file to benefit from that immediate expense write-off, thanks to this immediate expensing of R&E costs now.
Yeah, the ability to e-file 2022 amended returns will end sometime in December when they take that out of service. For the IRS only keeps 3 open tax years available to e-file, so they'll take it off sometime in December to get ready for 2025's filing. And what I've told my client, I've been working hard on my client amended returns for that, because I said, if we have to paper file these, it's going to be like the ERC refunds of, potentially you could be waiting for over a year on these things. Jordan, you want to move to the next slide, please?
There you go. Perfect. So I guess we can talk about some of the things that went away as a result of the OB3. The big thing I think that was publicized a lot also in the media was anything that mentions green or clean or electric. Those things got either completely removed or significantly reduced. Some of those items are already gone in 2025, like our EV credits to a degree, and then other residential type credits, those are going to be gone by the end of the year. And so, those are things that really, I think, require careful planning if you're still in process with those. When those jobs get completed, when they get placed in service, things like that, that is going to have an impact on the eligibility of those credits. But, again, legislation can change. And so who knows if in 2, 3, 4 years, if these things get brought back. I do think there was some surprise that these were removed to the degree that they were, just because of, having competitive advantage and, the types of jobs that they do create. But if we're looking at this OB3 bill overall and how to ultimately fund it, something had to give. And so, but looking into a crystal ball, it's probably not unrealistic, or it's very plausible that these come back to some degree in the future. But obviously to be determined in that regard. The last thing that I'll kind of mention that's buried in here is it's not effective right now, but what we're going to see is a limitation on our charitable deductions. It's not significant. It's only 0.5%. So, if you have someone that has income of $500,000, that's the first $2,500 of their charitable donations ultimately are non-deductible. So it's maybe not going to sway individuals with their philanthropic giving and planning as part of their year-end planning. It's probably just going to be more of an annoyance, a little itch. And then there is going to be a limit as well on our itemized deductions. And so, highest tax rate, 37%, this itemized deduction limit ultimately caps the benefit there at 35%. And then, some of the stuff that got expanded, obviously the state and local tax credit for individuals was a huge thing that was talked about too. And that got bumped up to 40, but there is a limit on your income as to whether or not you're eligible for this. So if we get to our, high net worth individuals who have more income than, say, that $600,000, they're not getting the benefit of this added state and local deduction. Perhaps their charitable deductions are going to get haircut. And oh, by the way, now you're not going to get the full dollar to dollar, or I guess percent to percent match on your itemized deductions. So, this would require, I think, a lot more careful planning for the individuals that it's going to apply to. But the itemized deduction limit can certainly have an impact, I think, on what we decide to do in 25 or 26, or bundling and accelerating certain deductions. So that's going to be an important thing to look at.
I'd like to expand on what you mentioned with the state and local tax deduction as well. The limitation there is what drove the implementation of the pass-through entity elective tax for the state. It's a workaround for that $10,000 limit for state and local taxes on your itemized deductions, where a pass-through entity can, instead of you paying the tax and being limited to $10,000, the pass-through entity can elect to pay the tax on your behalf. And that pass-through entity gets a full deduction for it without any kind of cap, like the $10,000 limit or the $40,000 limit, if that applies to you, which can be very beneficial on the federal level for Oregon business owners who own pass-through entities who are eligible to take advantage of that elective tax. That nothing in this federal legislation made it where those programs are no longer eligible, no longer qualified. It's that workaround still exists, and it's hugely beneficial to Oregon business owners. However, Oregon's current pass-through entity elective tax expires at the end of 2025. There was a bill in this past legislative session that would have extended it to 2027. That passed the Senate, didn't pass the House. So we're in this situation where we're heading into a legislative session next year in February. That's a short session, only 35 days to work with to get whatever legislation and conformity updates, those kinds of things that need to be passed in that very short window of time. If that's going to be a priority for the legislature or not remains to be seen. So I really would encourage anyone who's currently benefiting from that pass-through entity elective tax and the ability to deduct your state taxes in full at the federal level by having your entity pay for it. talk with your legislators and see what can be done there. I am not getting political here. I'm just saying from my perspective as a CPA who works primarily with pass-through entities, that provision at the state level has been hugely beneficial for my clients. And I know it's saved them a lot of money to be able to take advantage of that elective tax. So if you're one of those people, just be aware it expires 2025. By the time the legislative session is here in February, it'll end in the early days of March. There's something else that happens in the middle of March, and that is your extended deadline or your filing deadline for partnerships and S corporations. So when we'd normally be giving you your estimated tax vouchers for 2026, we may not know if Oregon's pass-through entity elective tax has been extended and whether that bill has been signed into law. So
Jordan, do you want to advance the slide? Because I think Katie's already been.
Oh, I went there ahead of schedule. Sorry about that, but I couldn't resist.
It's a good segue.
Jordan started talking about salt limitations, and I couldn't put the salt shaker down. Sorry, but yeah, there's a lot here with Oregon's connection to federal tax code. It's something that the Oregon Society of CPAs and practitioners across the state have worked very hard to preserve over the years because it aids compliance. You don't have to learn a whole separate tax code to be a business owner in Oregon, provided you don't expand in your operations into California, which has its own tax code. Oregon doesn't. Oregon piggybacks off the federal code, which makes it easier for Oregon business owners and Oregon taxpayers in general. And it has a long history of doing that. What makes the legislature nervous is when these huge tax cuts happen at the federal level. Oregon's tie to that means that if there's a reduction in taxable income, Oregon gets less funding through income tax revenue. And that can cause problems with the budgeting process. We don't have the luxury of having a sales tax to fall back on or to mitigate some of the impacts of sweeping changes with income tax at the federal level. And so that understandably makes the legislature nervous. And there was talk of pausing the connection during this past legislative session. And at the end of the session, they ended up not doing that, but it very well could be one of the key points of discussion in this short legislative session we're heading into in 2026. So something to keep an eye on, something to advocate for if it's important to you to keep Oregon's connection and keep things as simple as possible, where you don't have to carry a depreciation schedule that's different for Oregon than it is for federal tax purposes and that kind of thing. So I know there was talk also about like tips and overtime. We didn't really touch on that much in the previous slides, but those are areas where Oregon has talked about disconnecting from the federal treatment for tips and overtime. From an Oregon employer perspective, those two provisions in particular create some form issues, like how do you track the tips and overtime? How do you report them? Are there going to be changes to the W-2 forms? Not yet, but probably yes. What happens if Oregon disconnects? And you have to do all that tracking and reporting for federal, but not for Oregon, and somehow carry two payroll systems at the federal and state level. So it could be messy as we see what unfolds in this upcoming legislative session.
One other thing that we've got that we haven't touched on that we're still waiting to know about is, 2025 for Oregon is a kicker year. And so that kicker credit's going to get announced, sometime in November, when we're looking at the kind of the surplus budget that's there. Compared to 2023, it's about a quarter of what it was. So 2023 was historically high at 44+%. So likely not going to be that high. But that's another thing that we're going to see show up on our Oregon returns this year that will be helpful to taxpayers. But it's still an unknown. So it's hard to plan with that right now.
Next slide, Jordan.
And so I guess kind of getting more onto then, state specifics. There's, historically our firm has helped out, clients with doing residency planning. A long time, it's been looking at state of Washington, no income tax, pretty tax friendly. And we've seen, I think, some exodus from the state of Oregon, which has hurt, the local economy and then hurt businesses. But there's been, real incentives for people to look at that. Washington has their capital gains excise tax now, and they actually have increased it, the rate depending on the size of your capital gain. And so we're starting to, I guess, narrow the field a bit. And on top of that, Washington, while they increased their estate tax exemption from about 2 million to 3, they also increased the tax rate up to 35%. And so for Oregon versus Washington residents, if we're looking at someone's taxable estate, there can actually be a point in time where you might be better off being in Oregon. Oregon's threshold still remains at $1 million, but its tax rate is only 16%. So when it comes to residency planning, we're still looking at other states as well, or clients look at other states. But that jump from Oregon to Washington, I think we're starting to see that slow down, just because of a lot of the other things that the state of Washington is putting into play.
Next slide. Yep. Yeah, so I think kind of we alluded to a lot of this stuff already in earlier discussions on a lot of these topics, and kind of the overall key takeaways is it's nice that we've got these same strategies that we have been implementing for effectively the last 7-8 years are still pretty much in play. There are some new things, the qualified production property. There's some things that we really need to be looking at in terms of the R&D costs, what's better to when best to utilize that benefit if you had to capitalize. But from the business side of things, we didn't have a lot new in play. And so we're kind of using those same core strategies, which, and to Katie's point earlier, is great to get this in July. So I know I was very pessimistic that was going to be the case, that I thought that we would be sitting here on October 30th, potentially in a government shutdown with all these things set to expire and no certainty as to if and when there was going to be any extensions or tax legislation. So getting it early so that we can have these conversations with clients earlier. We know what our playing field should be for the next 3 to 4 years, and then we'll go from there is just key. But that there's, analysis, like I mentioned before, there's not necessarily going to be one right road. There's going to be some options. And so it's working and talking about here's the tax pieces for these different options. There are things that have other value and other considerations beyond the taxes. The role we play can be very important, but it's not the only one. The rule we always try to live by is don't let the tax tail wag the dog. You're not making decisions for tax reasons only. It's part of the analysis. It's part of the equation, but it's not the whole thing. And we help provide that piece so that business owners can make the best decisions for themselves and for their businesses.
Yeah, I think the modeling is going to be key in all of this, just making sure that you're taking into account state conformity, you're considering the temporary differences versus permanent provisions, temporary opportunities like that qualified production property. Like, how does that work into your multi-year analysis? We actually have that window to do multi-year planning now, as this law is, the permanent provisions in this law are about as permanent as it gets with tax. So we've got at least an administration to work with probably. So get that multi-year planning underway and make sure that you're monitoring and taking care of any unexpected results that come out from the interplay of these different provisions. There's so much going on here that it's hard to use intuition. You really have to put pen to paper and get those models in the works. And now's the time to do it.
Yeah.
So we
Nice.
welcome any of your questions. I don't see any in the open questions. Did you have any, Derek, that you wanted to add?
I don't have any questions, but we can pause. We have about 4 minutes that we have to spare for questions. If anybody wants to put some questions into the Q&A button at the bottom of your Zoom screen, we can start answering them.
Yep. And in the meantime, we can just keep talking if you want, because there's some other things that I noticed, like just talking about those core tax strategies with, taking advantage of reducing your tax by using deductions and credits and reduced rates and all of that. That's an advantageous strategy, as well as taking advantage of those timing differences where you can accelerate expenses or defer income. Those are great. We had listed in that defer category like-kind exchanges. That's where you trade a property for a like-kind property and don't have to pay tax on the gain. That's a great strategy. But you can actually move it from the defer category into the permanently exclude category if you happen to die with the property. So you get that step up in basis upon death. That can be beneficial, where all of these come into play. But that truly is as permanent as it gets with taxes, death, I guess. But yeah, it's an interesting world we work in, and lots of opportunities to take advantage if you know where to look and how to put all the puzzle pieces together in the right way that gives you the biggest benefit.
Yeah, I'm doing a lot of real estate. I've definitely had those conversations. My mom can't believe that part of my consulting strategy is telling my clients to die at some point. But it can be very tax efficient with real estate.
Yeah, I mean, that's the really important thing too, depending on, our clients and the business owners and the size of their estate. That huge $15 million federal exemption provides a lot of coverage and a lot of shelter. Oregon's only at a million, but that step up in basis, if I'm getting that step up in basis for both federal and Oregon income tax purposes, it might be worth paying the Oregon estate tax at 16%. So, you're looking at that as the cost of getting this extra deduction. It could be a win, but then you've got to plan accordingly and die with the property.
So we actually have a question from Jeff Miller. You mentioned the 20-year amortization schedule applying to the industrial investment. If a landlord acquires a newly constructed building as an investment opportunity, does this 100% depreciation apply even as an income producing investment?
So yeah, as a landlord, and this was actually new as part of TCJA, but as a landlord buying a income producing rental property, you have the ability to accelerate with 100% bonus depreciation certain components of the building. The best way to do that, or the way to maximize that most efficiently, is to get a cost segregation study, which breaks the building into different components. And that's the piece that's nice about that, is it does no longer needs to be newly constructed. Obviously, with newly constructed, getting that information for the cost segregation study tends to be a little bit easier, but it can be used for existing or used properties as well.
But I'm sorry, with regard to the qualified production property, landlords don't qualify though. So for those newly built, as part of this recent tax legislation, the OB3, those newly built manufacturing facilities, if you're the landlord, you don't get it. It has to be the actual operating manufacturing company for that.
Great. Thank you. And with that, I don't see any additional questions. And we've reached the conclusion of our program. Thank you to Jordan, Katie, and Trent. And I would like to remind all participants that a recording of this webinar will appear on OBI's website. And have a great rest of your day.
Perfect.
Thanks.
Thank you.